All right, well, with stocks officially open for trade, we see fractional gains across the board. The S&P up about 1% on the week, and the Dow close to a 1% gain as well. A lot of action even during these summer months between trade, Fed appointments, and the path forward for interest rates, plus earnings. So I'm joined now by James Demmert. He's the CIO for Main Street Research. James, it's great to have you.
Happy Friday, Caroline.
Yes, happy Friday indeed. So what do you make of the market signals that we've gotten this week?
You know, I think this week is a microcosm of what investors should expect over the next few quarters. Very stock specific, very sector specific. You saw some big winners on the exchange going up a lot, and then you saw some big disappointments. Investors really selling off some great quality companies like Lilly or Gartner just because they missed, even by a small margin.
Yeah. So how are you suggesting to clients that they position themselves in this environment?
Well, you know, this is a different environment than maybe where we were 6 months ago. And I think investors need to think going forward. U.S. markets have gotten very sensitive about going where the best earnings growth is. And we saw that this year, this week. Palantir with fantastic numbers. Stock was very much, lots of crowd behind that. And then you have Lilly, which of course disappoints, and the stock really gets beaten up. So I think investors want to be very stock selective, sector selective, and think, where are the earnings likely to be over the next few quarters? You know, the Fed is likely to probably, we think, a cut in September, a gentle cut, maybe 25 basis points. That benefits tech. That benefits the financials, which are already in a bull market. And we like that energy trade, the trying to meet the demand for electricity.
Yeah, we've seen some NYSE-listed companies like Disney and Uber see strong reports this week as well. So certainly a lot of earnings coverage that we've been doing here. I do want to get your take on President Donald Trump's new appointment to the Fed board. Stephen Moran, of course, replacing Adriana Kugler after her resignation. What does this mean for rates going forward?
Well, I think it leans towards being dovish. And, you know, we think the Fed should be getting dovish. Those labor reports have definitely shown weakness. I think that one of the risks for this market is the Fed is stubborn in keeping rates, which are restrictive right now, at these levels. And I think this is just one more bean on the pile. They're going to probably go.
I see buy the upcoming dip is a message that you've been supportive of. What more can you share about that?
Well, you know, this is a market that's 30% off the low in April. Who knew? And I think investors are now concerned that maybe stocks have gone up too much. We do think it's probably up for a breather, the indexes, but not much of one. There's a lot of cash still on the sidelines, so every dip sort of comes with, obviously, some buying. So our suggestion to investors is buy this chop. The market might be choppy. It typically is in August and September. Use that chop to maybe reposition a portfolio or put money to work in those sectors I mentioned. You know, that technology, for sure, the financials, the energy sector in the U.S. And don't forget to be a foreign investor. There's great valuations and very good economics outside the U.S.
Where do you see that opportunity when it comes to international markets?
Well, you know, the international markets are sort of taking a page from our playbook. Their fiscal stimulus is right on. Interest rates and monetary policy very easy. So it's no wonder foreign markets, the MSCI, is up 50% more than the S&P. I think a lot of investors have not recognized that. And overseas, you can be much more diversified. Certainly in tech, but the financials there are doing well. The industrial companies are doing well. Very broad exposure overseas, I think, makes a lot of sense.
James, what else should our viewers know as we head into the weekend?
Well, I think into the weekend, hopefully relax and not look at this too much. But next week, we've got lots more earnings coming. So, you know, we sharpened our pencil over the weekend, getting ready for next week's earnings. Earnings are really what drive this market. Other than that, that's about it.
Yeah, so earnings very much in focus. I know trade obviously as well. How are you factoring the chance that we could see some weakness in the labor market based on the latest numbers and downward revisions that last Friday's report revealed?
Yeah, we've got some inflation data coming up in the next couple of weeks, more labor reports. Our view is this economy on the labor side is weakening. The Fed has intimated a number of times over the last year they would sacrifice inflation to keep the labor market strong. And I think investors want to remember that. So that means that they'll probably, I think they're going to cut. It looks like the trend in labor is getting weak and I think they're going to want to save that from getting too weak, and they'll probably cut in September, which is, again, why investors don't want to sit on their hands here with too much cash, buy any kind of chop or the dips.
In terms of balancing between equities, are there other places in the market that look attractive to you in addition to equities?
Well, we were happy to see gold going up at a new high this morning, and we do have a position in that asset class. We think it makes a lot of sense. We play private equity by owning companies like Apollo rather than actually having the alternative investment itself. And I don't think most investors should be 100% stock, so we do a lot of work in the bond market, individual bonds based on tax brackets. And the bond market's a fantastic market these days, 4 to 5, 6% for safe money.
All right, James Demmer joining me in studio here. James, thank you so much.
Pleasure.
He's the CIO at Main Street Research.